Good afternoon, everybody. Welcome to JF Capital Unplugged. For those of you who don't know me, my name is Ellie Grotko. I've had the privilege and honor of working with Jonathan for the last for around a decade. And I just want to welcome everyone here to another special edition of JF Cap Unplugged. And I want to introduce my coworker, hotel extraordinaire, Jonathan Falk. Jonathan, welcome.
Thank you, Ellie. I don't know about extraordinaire, but thanks. Hi, I'm Jonathan Falk with JF Capital Advisors. I know a lot of the people that are on here, and this is the 7th version of our Unplugged webinar. We started doing it during COVID. I thought we were going to stop, and I've probably been at 6 industry conferences over the last 6 weeks. And I keep getting asked when we're going to do another. So we're back based on what I think is popular demand. We'll see after this if anyone wants us to do an 8th. We had a list of topics that we intend to address. This is being recorded. So we have 90 minutes of content. If you drop off, we'll have a recording available afterwards, and in theory, this is not open for the media or the press. If you're media or press and you're on and you'd like quotes or whatnot, just contact us offline, and we're more than happy to talk about things that we can, but this is essentially off the record. We had a list of topics, and Ellie sent me the questions he'd be putting to me. I didn't look at them. Because I didn't want to sound rehearsed or boring or whatever. So we're going to see how it goes and where it goes, but we're going to cover a whole bunch of stuff and hopefully have some fun doing it. So Ellie, why don't you take it away?
Okay, so my first question, my first topic is, it's no secret. I think we actually touched on this last time at JF Capital Unplugged 6. It's no secret that labor continues to be a major problem for the hotel industry as well for the entire country, both with respect to securing employees as well as with respect to the cost of actual labor. Do you expect either of these two issues to ease over the next 12 to 24 months? And my second part of this question is, what are hotel owners doing, or what should they be doing about possibly blunting the impact of the cost of labor and finding employees?
Okay, so we could do 90 minutes just on that, but we'll try to keep it at a high level. Labor is an issue in just about every market, and not just for the hotel industry, but especially for the hotel industry. When you look at the amount of turnover in the hotel industry, it's huge on a regular basis at the line level, but also at the managerial level. And one of the things that we've been spending a lot of time on in our asset management business and our advisory business is really educating owners, and in some case making it more clear to operators that there's a huge amount of inefficiency and a huge expense involved with having to recruit, replace, retrain, rehire people, but there's no line item that shows it to you. There's no line item in the hotel P&L that says, here is the loss or here is the operating expense related to turnover and recruiting. I mean, you'll see recruiting expense pop up in the P&L, but there's nothing that shows how much time is spent by hotel management teams in recruiting, in training, and how much lost time and effort there is from having hotel executive committee staff either making beds, checking people in, or doing jobs that are not their primary jobs. So if we were able to quantify it, and we've been trying to do that in our asset management business, we quantify kind of what we think the impact of the turnover is. You start to think a lot more about recruiting better, compensating people better, which is always a difficult thing to do when you say we need to pay more or we need to give bigger or better benefits. But if it really reduces your turnover and really reduces the amount of training you have and creates better staff morale, whether it's through higher pay, better benefits, a little bit more flexibility, I think you win in the long run. And what's happened is through COVID and through through every crisis, the hotel industry gets a little bit smarter about operating efficiencies. And here, I think we've gotten a little bit smarter as an industry, but not smart enough in terms of how to better attract people. One of the conferences that I was at was Ambridge's Fishing for Solutions conference. And on my panel, there was one expert in employee benefits and one in property and casualty. We'll talk about the property casualty in a little bit, but in terms of the employee benefits, one of the most interesting statistics was that the vast majority of workers' comp claims happen in the first 90 days of employment in the hotel industry. So if you think about that, in the first 90 days of employment, someone comes, they hurt themselves or they think they hurt themselves, and all of a sudden your workers' comp premiums are going up, you're paying more to replace that person. So if you can cut down on the turnover, you're going to do way better in terms of your insurance premiums, as well as all of the other things that I talked about before. So is it going to get better? Marginally. It's not going to get way better because there are a lot of competing industries that in some cases don't require as difficult a workload. And when you look at the available jobs, I think we'll pick up some people as some companies have started layoffs ahead of tighter earnings and a contemplated recessionary environment later this year, but really not enough. We're seeing a lot of layoffs in tech and some in finance and banking, but that's not typically who's making beds or checking people in or serving hamburgers or cocktails in restaurants. So, when you think about the wage scale that we pay to hotel employees and compare it to other industries, we're basically at the bottom. And we're at the bottom because we have a lot of entry-level positions, we have a lot of unskilled labor positions, but we're at the bottom. And we need to be much smarter as an industry, and I'm convinced we'll continue to get smarter, but we need to get much smarter about recruiting and especially retention.
Very, very interesting.
Did I answer your question? I know I said a lot, but did I answer?
Yes.
Okay.
Something that, inflation has obviously not only been affecting the salaries and benefits that owners have had to pay to their staff, but it's obviously also anyone that's gone on vacation in the last year has kind of seen an uptick in the price of the airfare, the price of the hotel rooms, which I guess in some ways has been good for average daily rate. So, over the past, I'd say, since 2023, research is expecting ADR to be 15 to 20% higher than it was in 2019. Do you think this trend of ADR, especially at the luxury upper upscale segments, to continue?
No.
Okay.
No, but let me get more into it. So one of the questions I've been asking over the last 9 months and just started to be addressed at some of the industry conferences is the ADR that we're talking about and the RevPAR that we're talking about are in nominal dollars and actual dollars and not inflation adjusted. So if we just reset the stage a little and back up about 3 years, right? Now we're in June of 2023. In June of 2020, we were beyond the stay home for 14 days or 10 days or whatever to stop the spread. We were, in the middle of what I'd call kind of COVID hell for the hotel industry, where we had very little visibility. We didn't know what was going on. In a lot of cases, we went from 70, 80% occupancy to 10% or 20% occupancy in full service hotels. And no one had a crystal ball. And all the prognosticators, STR and CBRE, LARC, others, everyone's, models were telling them that RevPAR would return to 2019 levels sometime in 2024. Now, RevPAR returned to 2019 levels in 2022 because we had a huge amount of inflation. And the inflation, even though it was promised to be transitory, it was not transitory. And now we have reducing growth in inflation, but we haven't taken back that inflationary force. So when you look at the ADR growth, right, in many markets and overall in the country, and you inflation adjust it, take out the impact of the inflation that we have, we're not back at 2019 ADRs or RevPARs. We're still shy in almost all markets. So one of the things that I didn't really understand why no one was talking about, and I kept asking, and this was of some of the industry prognosticators, but others, like, why aren't you measuring and why aren't you producing data on real ADRs and real RevPARs? Because it's very easy. If there's inflation, great. We have inflated revenue. We also have inflated expenses because we're paying more for everything, for food products, for laundry, for wages, for absolutely everything. So, it kind of comes back to the question you didn't ask me, but people have been asking for decades about the hotel industry. Is the hotel industry inflation resistant, or is it recession we know it's not really recession resistant. Is it inflation resistant because we can reprice our ADRs on a daily basis? And the answer is more so than other asset classes like office, retail, even multifamily, where they reset once a year. We can't reset all of our ADRs overnight. We lock into corporate rates, we lock into group rates, but we have more ability to reset both up and down. And what we've seen is inflated ADRs. In some cases, we've seen inflated F&B revenue and other revenue, but we also have inflated expenses in basically every expense line item. That's in utilities, that's in insurance expense, both employee benefits and property and casualty. It's in the admin and general cost. It's in repair and maintenance. It's costing more to get people to come and repair things. If we don't have staff, we're paying for contract labor and we're paying more. So, I think many people are really sort of missing the underlying kind of issues in the industry, because we are not back at 2019 levels on an inflation adjusted basis. Now, fast forward, if you have inflated NOIs, but you have constant dollar debt, right? So if you have $1 million of debt and your NOI is growing, in theory, if you can repay your debt with constant dollar NOI at a certain cap rate or a certain debt yield, that works great for you. And in a rising hospitality industry market, a lot of people have made tons of money that way because the NOI has improved over time and they paid off constant dollar debt where the debt is not inflating. We're in a position now, I'm sure we'll talk about it in a few minutes, where getting that debt to refinance or new debt in order to sell a property is really, really challenging. But I think the inflation issue is here for a while. I don't think inflation is going to, and this is not really an economic forecast, it's a practical forecast. I don't think inflation is going to come down to 2% anytime soon. I think there will be a lot of push from the current presidential administration to push it down in advance of the election, but it's difficult to put it down when you keep printing money.
Right, gotcha. And do you think, you mentioned the debt, do you think people are more focused on ADR growth and RevPAR growth in current dollars because of the debt pieces, and because they're thinking, well, if you owe $100 million and you're paying 5% based on debt that was sourced in 2019, 2020, we don't have to worry about that as much in terms of the inflation impact because of the way that we're just still paying current interest on those lower rates. Obviously,
so there are a lot of complicated things happening in the debt capital markets, but one is there are a lot of people that are moving along and doing fine because they have fixed rate debt, with no near-term maturities. The majority of private equity investors, don't borrow in the 10-year market. They borrow in the 5-year market, and in a lot of cases, floating rate.
Right.
So even if they have interest rate caps, and normally a hotel lender, whether it's a bank, a private equity fund, a debt fund, is going to say, okay, you have to have an interest rate cap at a certain strike price. And it's a 5-year loan, so buy a 5-year cap, and the price of that is high. And it's high because of the optionality in the capital markets. So a lot of people have said, let us buy a cap for the first 2 years or 3 years of the loan, and then we'll have to buy a replacement cap. And if we don't, it will be an event of default, or might even be a recourse event. So we guarantee we'll buy a replacement cap. Well, the cost of the replacement cap for most of those loans in the last year has gone up somewhere between like 8 and 30 times what it was, depending on how long, whether it's 1 year, 2 year, 3 years, and the strike price. And even the day that you bought it on. So there's a huge increase, and there are a lot of people that are required to buy replacement interest rate caps. And while that might have been a few $100,000, a couple of $100,000 outlay, now is a couple of $1 million outlay, and is meaningful dollars. So that's piece one that's important to understand, and that's putting pressure on borrowers. Piece two, if you're a floating rate borrower, right, you've been watching your interest expense that you're paying just explode month after month after month, and it just kept going up, and it looks like it just stopped. It looks like we just plateaued. We just had the last Fed meeting, and they paused. They didn't say, okay, we're getting ready to lower rates, but they paused. But you see someone who was a borrower at SOFR plus 300, and SOFR was 20 basis points, right? They were paying 3.2% interest. Now SOFR is over 5%. So they're paying over 8% interest, and a lot of the deals were not sized to handle that. And even if they weren't, could handle it, it's eating up all of the cash flow. The other kind of piece to it along the way is if you're a fixed rate borrower, you're locked into lower debt service today, but when your loan comes due in a year, 2 years, 3 years, 4 years, you're going to have a big problem, because if you had borrowed at 70% LTV before at a 4.5% interest rate, there's a good chance you're going to be borrowing in the next year or two at a 65% LTV at an 8% interest rate. And if you're doing it today, it would be even more. So, so that's problematic in a lot of different ways. And in some cases, it's just deferring an issue if you have fixed rate debt. Now, if you have fixed rate debt with term on it and can ride it out, you might be doing just fine. One of the things we're going to see is, how amenable are lenders going to be when borrowers come and say, like, I can pay you current, I just can't refinance the debt right now. And that's not me. I don't think anyone could refinance this debt right now. I need more time. And depending on the lender type, right, some will say, okay, and some will say, okay, we'll take the asset. And a lot depends on what basis. I think we're going to see a lot more lenders moving to sell loans because they don't want to take bad loan. They don't want to keep bad loans on their books, especially if it's a commercial bank. In a lot of cases, they don't want to really be foreclosing on their borrowers, so they may be doing other business with. They'll get out of it and sell. And we've seen a bunch of that over the last few years, but we haven't seen big discounts on the loans. I think we're going to start to see bigger discounts on the loans because it's just going to be tough for banks to keep them on their balance sheet. There are going to be certain funds that have made loans that, even though in theory, when their investment thesis was, we can own it at our basis, they don't really want to own it at their basis today. And that might have been a different analysis a few years ago. Additionally, I've said this before when asked, Ellie, like you and me and the team at JF Capital, we did 26 debt restructurings during COVID. About a quarter of them, and they ranged from small to a few $100 million. And about 25% of those had new equity, like meaningful amounts of new equity come in, new 5 to 7 year capital structures sort of solved for with all the parties in the capital stack. 75% of them, were basically 2-year fixes. We'll put in a few $1 million of equity. We'll fund whatever reserves. We'll make sure to pay property taxes. We'll make sure to pay the ground rents, et cetera. We'll fund operating losses, but we need some relief on interest rate. We need some relief from the senior lender, mezz lender, any other lender in the stack. We need some relief on debt service. We need some relief on covenants. We want to raid the FF&E reserve, and any other reserves, we'll replenish it. They got approvals and permissions from the brands to do that, from operators to do that. And the thought was we're going to ride through, a year or 2 years and then be back to normal. And most people putting in those few $1 million at a time into those deals to restructure them, to push them along, if you told them that short-term interest rates were going to increase by 500 basis points over the course of, 8 or 9 months or 12 or even 12 months, in the foreseeable future, they wouldn't have put $1 in. They would have said, here you go. And so we're seeing a lot of those come due. They've either come due or are due and need to be restructured again, but we're in an environment where it's very difficult to figure out, should we be putting money in? Mm-hmm. Should we be putting money into this or not? Like, I don't get it.
Right. You touched on it briefly, but what does the mezz market look like today? Obviously, it looks much different than it did a few years ago, both in terms of interest rate as well as terms of LTV. And what are mezz lenders requiring that maybe they weren't requiring a few years ago?
So a few things. One is the rates are obviously higher. So a mezz lender that might have been at 12 to 14% before is now at 16 to 20. But a lot of it depends on what kind of asset and where it is. If you went to find a market for mezzanine debt for hotels in San Francisco, right? Most people would just hang up the phone on when you say, hi, it's Jonathan, I want to talk about San Francisco. They'd just hang up the phone. Say like, sorry, I like you. Call me when you have something positive to talk about. And there are certain markets like that. And I like the city of San Francisco. So I'm not picking on it, but from an investor perspective, you can't find that. We're finding mezz lenders, not too dissimilar from senior lenders, are underwriting a lot of stuff. They're reviewing a lot, but not putting out a lot of term sheets. They are, but it's got to be, they basically, it's kind of like a lender's market, not a borrower's market. So they have their choice of sponsors. So the sponsorship has to be really good. The business plan has to be really good. It has to be thoughtful. The underwriting has to be good. The operator has to be good. And even then, it's not so easy to do. And if you're a borrower, it's difficult to think about taking on mezz debt at 16 to 20% or 16 to 18%. In some cases, it's requiring some level of guarantees. In some cases, and we're seeing this more on restructurings than on new originations, but in some cases, they're asking for this like deed in a box concept, right? Where, for those not in the mezz market, the deed in the box concept is if there's a material default or material event of default, then there's a deed already there that the mezz lender can take, so they can essentially step into the equity without having to go through a whole lengthy process. And in other words, it just makes it really, really simple to get to the asset if there's a borrower default, instead of going through foreclosure and maybe legal challenges to that and maybe a BK and all of the legal machinations that go along with that. So you're seeing mezz lenders want more structure, but they definitely want fresh equity behind them. And one of the things that we're seeing in the debt markets, and we haven't seen this in a long time, but so the terminology has come back, is the cash in refinancing, right? In the best of times, we talk about cash out refinancing, where you can refinance the existing debt and take money out and put it in your pocket. Now the majority of loan situations we're seeing are cash in refinancings, where there's additional equity dollars that need to be funded. And it may be to get to the right LTV. It might be to replenish, debt service and FF&E reserves. It might be to be able to fund a PIP that should have been done in 2020, and now in 2023 is not being done, right? And one of the things maybe we'll get to on this is, the brands were for the most part very, very, very good and very cooperative for the most part. With good franchisees and good owners throughout the sort of thick of COVID, right? They were pretty accommodating on brand standards. They were pretty accommodating on deferring PIPs, on even taking FF&E reserve dollars. So I'd give each of the major brands big kudos for that, and thank you for that. Now they're a little bit more testy, and that's because their balance sheets look a whole lot better. And if RevPAR has exceeded 2019 levels and ADR has exceeded 2019 levels, and a PIP was supposed to be done in 2019 or 2020, it's now 2023. They want to see how it's going to get done, and they're right. They're in the fee business, but they're also in the branding business, and their brand needs to have a certain promise, right? And if you go to a Marriott hotel or a Hilton hotel and it's falling apart, right, that's a reflection on them and their brand, right, and on their brand value and proposition, and that impacts other properties. So I think I steered away from your question on mezz, but a lot depends on who I'll sum it up again, and it's who's the sponsor, right? How much equity are they putting into the deal, right? If they're putting new equity in, who's the operator? What's the brand? What's the business plan? And it better not be like we had a record year in 2022 in this leisure resort market, and and that's just the base, and we're going to grow off of that forever and ever, because that's not playing out.
Right. Yeah. So continuing on that theme of sort of the leisure market versus the business market, if you're talking about the revenue mix, obviously during COVID there was no mix because people weren't traveling, and then after COVID there was no business travel, but there was a bunch of leisure, and now we're starting to see some business, some group coming back, especially So I'm just curious, research, they think that occupancy is going to stay around mid-60s the next few years. How do you see that mix flowing? Do you see the transient kind of coming back down and business picking up the slack? Do you see transient continue and business kind of slowly upticking? Where do you see kind of that mix of business playing in?
So the answer is it depends, right? And it depends everywhere. A few things have happened. One is the work from home or work remote concept. In a lot of cases, that's not going to work full time, but we're seeing a lot of businesses that are going to, you're in the office 3 days a week, or, and those that are in the office 3 days a week, I think are going to go to 4 days a week, and ultimately end up, if you want Fridays to work from home or Mondays, or, or you pick it, you can work from home or work from remote. Now, the idea of work from home doesn't actually mean home, right? I've been on the road for the last 25 years, working out of hotels in different markets because we go where the deals are, right? And we're more productive when we're on site. So I'm in a home office, I'm in our New York office sometimes, but, a few days here and a few days there, and then on the road. So there are plenty of people that have been used to working like this for a long time. Not everyone can do that based on who they need to interact with, how they need to be trained, what they need to do. But if we do have a more permanent 3-day, 4-day work week in the office, that means there's an additional day that can potentially be used for leisure travel. Now, don't tell that to the employers, right? But that can be used for leisure travel. So if you're going away for a weekend, you can leave on Thursday night instead of leaving on Friday night, right? Or you can come home on Monday night instead of coming home on Sunday night. Which changes the whole composition of revenue management as we've historically known it, as we get much stronger Sundays and much stronger Thursday nights and Friday nights than we otherwise would have in certain markets. So tell me your full question. I started to answer some of it.
Well, I was going to say,
how does the business mix? Okay, got it. So, business travel got whacked, and then business travelers started getting back on the road. And 3 years ago, I was traveling for business, but I might have been in jeans and a sweater. And you saw very few suits and ties in the airports and on planes. You saw very few people with briefcases. You saw lots of people with backpacks and sweatpants. We're still not seeing as many people in suits and ties and with the briefcases, but there's a lot more, right? They're moving, and there's a return to meetings. It's not happening at the same velocity that it had before. Part of that is a function of there are certain markets where a lot of people are still not in offices. So are you going to fly into New York City and then, try to figure out what suburban cafe to go meet people in? So that might be an overgeneralization, but there are certain markets where you're not seeing the business travel pick up as much, and certain where you're seeing more. Is it going to come back to the same level it was at before? Unclear. Probably not, right? However, if people are doing a lot more remote work and people are out of the office 2 days a week or 3 days a week, or less people are in one location, it becomes way more important. And in this we've seen, it becomes way more important to have group events, group meetings, group training, group get-togethers in order to create some culture. I've also seen sort of a real resurgence of people attending industry conferences because they want to get together with their friends and colleagues in the industry. In some cases, if they're working from home, their families are telling them, like, remember when you used to go to an office, or remember when you used to go to these conferences? Yeah, well, maybe you should go. Isn't that important for your career? And it is important for the career, right? To have professional networking, to see people. And if you're working in a big company and working remote the majority of the time, right, it's going to be difficult to get trained to go to the next level. It's going to be difficult to get promotions. It's going to be difficult to figure out how to advance your career. So people are going to go to as many industry conferences as they can. And it's going to be their only real way to network effectively. So we're seeing group accelerate, but the booking pattern is a lot different than it was, right? So in 2021, group was mostly dead. In 2022, it was coming back stronger, but there were a lot of corporate travel planners and a lot of meeting planners that were getting organized for group events, but weren't pulling the trigger because they weren't sure. They weren't sure by the end of 2021 if we were going to have additional lockdown mandates. If, I remember in January of 2022, LA was getting ready to go back to, full mask mandates, right? And that has an impact on who's traveling where and for meetings and events. Now we're seeing them book, but other than some big stuff and the Ryman properties or the Gaylord properties, what we're seeing is a lot of small to mid-sized group being booked on fairly short-term notice. Whereas before, years ago, it might have taken 6 months, in advance to book a 4-day event or 3-day event for a few hundred people. Now it's happening a month out, 5 weeks out, and smaller groups are happening a week or 2 weeks out, right? So it's making revenue management a lot more difficult. And by the way, we're seeing the same thing in the transient side for both business and leisure. We're seeing such short-term bookings where so much of the bookings are in the week for the week, even in the day for the day, that you may go into a month now, with not a lot on the books, but you feel pretty good about it, and you hope that it materializes. So we're going to see shifts. I don't think the overall occupancy changes that much, because I think if there's less business activity, right, that means people have a little bit more leisure time on their hands, right, and they'll fill up with leisure. So I think in different segments and different markets, I think you're going to see differences in terms of what comes back at different rates. And overall, like if you look at all the industry prognosticators, yeah, they think you sort of reemerge in a few years in the low to mid 60s on an occupancy basis, which is kind of where we were, in 2019 and previously. So, no one is seeing a lot of significant occupancy growth. Now, of course, that changes submarket by submarket and grand market by grand market. The other thing that the industry prognosticators and projectors are showing is, we had pretty good RevPAR growth last year. They're expecting some RevPAR growth, like low single digit to mid single digit at the highest this year. And then after that, the RevPAR growth, the ADR growth and the RevPAR growth, if you look at CoStar, if you look at HVS, if you look at PwC, if you look at LARC, CBRE, they're low single digits, in some cases below inflationary growth, which should be a little bit alarming. So if you're looking at a lot of pro formas that show massive growth, right, there better be a CapEx story to it, a branding story to it, something that's gonna actually generate that growth, because if you look at the overall projected demand for rooms in the industry, not that high.
There are also, you mentioned San Francisco before, there are also certain markets that lenders, investors don't really want to get so involved with, don't really want to touch. What do you think about those markets in terms of the San Franciscos, the Portlands, the downtown Los Angeles, so those markets that we're very dependent on, still are very dependent on business? Is this, would you say, a good investing opportunity in those markets, or would you say it's more of a trap? You still kind of see how things need to play out before you personally would advise a client or use your own money to invest in those markets?
It's a great question, and one we're asked a lot as people are investigating different markets. I'll go back to 2009. I was sitting on a panel. It was at some hotel in New York City, but it was an industry conference. And the last question on this panel was like, what market do you like and why? And probably four there was a moderator and 4 co-panelists. I was the last one, so they stuck me in the corner basically. And it started with like, I like New York and LA. I like New York and San Francisco. I like New York and Miami. I like Boston and Miami. And it came to me and I said, I like Detroit. And they all looked at me like, who's this joker? And the moderator said, okay, I thought we were done with the questions, but can you explain? I said, well, if I can go buy full service hotels in Detroit for 40 to 60,000 a key, put a little bit in, I don't need a brand. I don't really, as long as I have some term on whatever debt financing I put in place, my cash on cash yield is going to be tremendous. So I'm probably not going to sell that at the end of the day to an institutional investor, but on a risk adjusted basis, that's way better, right, than investing into New York City in a very competitive market where you just heard everyone is trying to jump in. So, a lot of it is a function of basis. A lot of it is a function of what the source of your capital is. So if you raised capital from a bunch of pension funds and whatnot, they may not want to hear that your thesis is we can buy at a tremendously low basis in certain markets that are beat down, and we don't need huge market recovery, to make a very good return. They would much rather you deploy money into the biggest, fanciest markets, at a subpar, or less optimal return. And that's just how, that's how some of the institutional landscape works, not all of it. So you'll find smaller, more opportunistic investors going into some of those other markets. But the best correlation of there are two things that I think are the best correlation factors to successful hotel investments. One is basis, and one is the term of your capital. So if you have enough term where you don't have to buy something, fix it up, do whatever, and trade out of it in 3 years or 4 years or 5 years, you can do things that are a whole lot smarter from a long-term and value creation perspective. If you need to just get in and get out, you're kind of playing a timing game, and a lot of that is not so much a matter of who's got the best thesis. It's a matter of flow of funds and what's happening in the overall world and the overall capital markets, right? Which may beat up on you or not beat up on you. So, I don't like or dislike any markets. I just need to understand what the basis is and what the risk adjusted return is, in those markets.
Gotcha. So, you mentioned that, you're not a fan of the market. You're just either a fan, basis is very, very important. Obviously, the terms of the debt that you can get is also very important. And that's changed a lot. I know that we touched on this around 15, 20 minutes ago, but given how much rates have changed, what kind of deals are getting done today? How are buyers and sellers adjusted to these higher rates, and how that kind of, impacts the pricing expectations, both in terms of kind of someone that's had an asset for a long time and kind of has these visions of, well, in 2019, my asset was worth X, so I want X, versus the buyers who are like, well, we can't pay X because, our cost of capital just went up around 500 basis points.
Yeah, so you're not seeing a lot of transactions, right? There's not a lot of transparency and not a lot of data points that will tell you where things should trade. There are certain transactions, and there is debt financing available. So with each transaction that you see announced, if you want to really understand it, you have to look at where's the debt coming from. Is there seller financing? Is there assumable debt? So if someone had a 10-year CMBS loan and they're 4 years in, and someone else can assume that loan, right, can assume that loan at a 4 or 5% interest rate and have another 6 years of term, right, that's pretty attractive. Where you're going out to find new debt financing for an existing asset or for an acquisition, it's just a much thinner market than it was before. Again, because their lenders are sitting in many cases on a lot of capital to deploy, but they're way more selective. And you better have the right plan, the right strategy, the right team to affect it. You better have realistic. It's okay to be optimistic, but realistic at the same time. Pro forma and financial analysis to be taken seriously, because many lenders are just going to look at something and say, if it's too much of a stretch, I'm not going to take the time to underwrite it. I'm not going to go to my investment committee and pound the table and say, this is a deal that we should do. We're seeing, if you're a first-time investor in the hotel industry, real uphill battle. Right. If you've been doing it for a while and maintain relationships, it's going to be easier to lean on and leverage those relationships to get things done. But, very few people are doing deals and, buying something, taking on debt in today's terms, thinking that's the debt that they're going to have 40 years from now. Mm-hmm. Right. So most underwritings and most models we see show you don't refinance the debt. This is what it is. But the real business plan is refi the debt after 2 years or after 3 years into a much better market, where you can achieve higher proceeds at a lower rate with a more friendly borrower structure. And we'll see, we'll see if that materializes. I think it will because we run in cycles, but it's tough to pin down exactly when.
Right. You just mentioned that most people, or a lot of people that are buying today, are looking, kind of saying to themselves, this is not the rate I'm going to be paying in 4 years from now, looking at the forward curve, expecting rates to come down, hopefully later this year into 2024. What are your thoughts? Because obviously, if you looked at the same curves, the same forecast 3 years ago, you would have seen LIBOR staying below, 1-2% for the next 7-8 years until 2030. Now, obviously, those expectations, those forecasts are all thrown out the window. Where do you see? Do you think? I know this is a crystal ball question. Do you think, that this time the forecasters have it right in terms of, hey, listen, we're about to hit the top, and then we're going to come a little bit down, and we're going to stay around?
I think they have it more right than wrong, and it really has almost nothing to do with econometric forecasting models and fancy PhDs that understand sort of where rates should be. I think 2024 is a presidential election year, and I think if we get to a point where interest rates have not come down halfway through, to some extent, halfway through 2024, right, it's very difficult for whoever the incumbent is to get reelected. And it has nothing to do with office buildings or hotels or debt yields. It has to do with individuals who vote. Right. And they either own homes or want to buy homes, and their memories are fairly short, but they remember just a couple of years ago where they could, get a 75 or 80% mortgage on their home at 3.5%. And, now they could get that 75% mortgage at 6.75% or 7%. And that's not a winning proposition for the incumbent in the White House. So I think even though the Fed is supposed to be independent, it's not. And, and that's not a party affiliation thing. It's just not, right? If the president can take action and remove the chair of the Fed, it's not independent. So I think you're going to see a push to start lowering interest rates. I don't think they can wait until February or March of next year, because the rate declines would be a little too much and too quickly. I think one of the things you're going to see is, and this is just my perspective, so I have no empirical data to back it up, but I've watched through I think 4 different cycles in my career now, and I've tried to study earlier cycles as well. Once you see interest rates start to taper down a little bit, you're going to see more and more lenders come into the market, right? That doesn't mean all of a sudden, you can have 20 term sheets on every deal, but you're going to see more lenders come in. You're going to see certain investors willing to take a little bit more risk because they're no longer worried that rates are continuing to go up. They think we're moving on the way down. And as certain trades get printed, right, and people see things, their competitors are going to watch. And, and I've seen it. When I worked at Bear Stearns a long time ago, I saw this, and we get asked all the time, like, how can we miss that trade?
Right.
How can we miss this? Who got it? Who did it? We need to be more aggressive the next time. When you see things start to open up. Now, not all the way, and as rates come down, I don't think we're coming back to 10 basis point or 20 basis point SOFR anytime in the foreseeable future, maybe even the rest of my life. But I think we're going to see short-term rates come down to 3% or so, maybe a little bit beneath. But that's roughly where they should settle. And that's and that's lower than where historical borrowings have been, right? I mean, we've gotten addicted to almost 0% short-term interest rates from 2009 until partway through 2022, right? Until like May or so of 2022. In March of 2022, if you were looking to buy a hotel in 2003 or 2006, you were getting a loan at 65, 70%, 75%. You were paying LIBOR plus 350 with a 5-year floater, 2 years of interest only and 25-year amortization, and 30-day LIBOR then in 2006 was like 5.25%.
Right.
It was, so like the rates we're at now are not crazy, and if you go back further, you'll find rates much higher, that went higher into the teens and up to 20%, in the 80s. So rates are not high by historical standards. They're high by standards of the last 15 years where we've had artificially low interest rates. So they should resettle at more of a market rate. And maybe that's not 5% because of the amount of money we've printed and put into the economy and seem to be willing to continue to do so. But I think you're just going to see all the momentum pieces happen at the same time. There will be greater conviction in the underwriting and an upside story combined with a reduction in base rates. There will be competition amongst lenders, and you'll start to see the market normalize because no one wants to miss the trade.
Right.
At some point, if you miss too many trades, you worry about your year-end review and your seat and your job.
All right. Before I get to my next question, I see we have some questions already in the queue. If anyone has a question, we'll leave some time at the end to have some Q&A. I think it's Jonathan's favorite part of this whole thing.
Oh, Ellie, you want to do the questions now? Let's do them now, just so we don't run out of time.
Okay, fine. We have a few questions right now. I was going to kind of piggyback on something you said, but we will wait. Okay, so we have a question. Why do the industry pundits continue to say that travel demand is back to 90% of 2019 levels? We are a geographically concentrated portfolio in the mid-Atlantic region. So I understand that I do not represent the broader U.S. industry, but when I talk to owners across the U.S., no one says they're back at 90%. So, does this make any sense?
Oh, there's some that are back way above 90%. Right. It's when you look at the overall industry statistics, they're very misleading, right? If you say industry occupancy is somewhere in the 60% range, well, go to New York City and that's not 60%. It's a normalized, like 90%, high 80s, 90% occupancy market, right? So function of supply and demand, there's a lot more interest in going to both leisure and business and group, going to certain states that are more friendly for business, that are easier to access, that have leisure components. So, you're seeing even with some trail off now in markets all over Florida, right? You're seeing some trail off from record high ADRs. Right, there's still significant demand. Right, there's still significant demand into New York City, right, and there will continue to be as international travel comes back in. But grouping all the markets and all the regions together gives you like a really bad answer, and you've got to get much more granular on an asset by asset basis within your portfolio. And I think we'll continue to see. In the markets that were lagging, we'll continue to see some upward lift, but the question is, why does someone need to go, to those markets, and are they very expensive? Right. So if I'm flying somewhere, right, and airfares are 50% higher than they were, right, that eats materially into what I'm able to spend, whether it's leisure or business.
Mm-hmm. Okay. We have another question about, can you give an outlook overview or your thoughts on the Miami, South Florida market. Obviously, it's been a very strong hospitality market. Do you expect this trend to continue? Is this maybe possibly a little bit too hot of a market, meaning that there's too much money flowing into one really good idea? That's the Miamis, that's the Austins, that's the Nashville, things like that. You guess you can kind of broaden it out a little bit.
Sure. So just under 1 year ago today, I moved from New York City, where I was a resident for a long, long time, to Southern Florida. I now live in Boynton Beach, Florida, halfway between Boca and West Palm Beach. I'm in Miami Beach quite a bit. Right now, my computer shows 91 degrees and super humid outside. So today's a cool day. But basically, one of the real reasons we moved down was, is more business friendly, more just easier living, and much lower cost living, right? To have a similar or even better lifestyle. And, when you think about the hotel industry in Miami, it was open when most of the country was shut. It was open. The Florida business climate is business friendly, so they try to attract inbound businesses, and you're seeing, outflows from states that have very high tax burdens, but also a lot of operating regulations, very high wage scales. So you're seeing an outflow from New York, from New Jersey, from California, right, flooding into Texas, flooding into, cities like Nashville, going all over Florida, Southern Florida, Northern Florida, they're on fire. And that's going to continue because it's a function of, if you tax your people and your companies to a certain extent, they find a cheaper way and a better place to be. So I think there's a lot of mentality permeating certain city governments and certain state governments, and that's not changing anytime soon. They seem to have a mentality of let's assault, and let's go take from those that have made more. Well, those that have made more are going to figure out how to keep more, and they're going to go elsewhere. So I don't think a jump in some of those markets is short-term in nature. Now, can the record high ADRs that we saw in Miami Beach, last year continue? No. And we're seeing the drop off now. We're seeing it in almost all of the high-end leisure markets, because there are different areas where people can go. Right. So a year and a half ago and coming into 2022, the cruise industry was just starting to reopen. Right. It wasn't easy to go from places in the US to Europe or Asia without quarantining on one side or the other. It was difficult for, outbound people to come into the US. I think just about 2 months ago, we lifted the COVID vaccine mandate in terms of internationals, non-US citizens coming in. Like, I'll tell you one issue we had in January of this year. We were supposed to be on a board retreat where some of the board members were coming from Europe and they were not vaccinated. So we were supposed to be in Miami Beach. It was all booked, it was all arranged. And on short notice, we switched and we went to, a luxury resort. We went to Mandarina in Mexico instead of the Edition in Miami Beach. And, there was no COVID mandate in terms of people coming in or coming out. So, one of the things that happened, and I did this, I left New York City in 2021 and went from January through May. I rented a place on Miami Beach at 51st and Collins, and I was doing all my same meetings, had access to Fort Lauderdale and Miami International Airport, and was able to go wherever I wanted from those airports, could work from the beach instead of working from Union Square in Manhattan with all sorts of craziness around me. So there, are the record high leisure ADRs sustainable? Absolutely not. We're seeing that in wine country. We're seeing that in various resorts. We're seeing it in Miami Beach. I think the demand will be higher than it was. I don't think the ADRs fall back to where they were pre-COVID, but they're dropping because people can pick up and go to Europe. They can go elsewhere in the Caribbean. They can go anywhere in the US that they might have had more challenge going to. They can go to Canada and back. Like I have relatives who had a tough time, like Canadian citizens, were like, well, I can go to Canada, but then I have to quarantine for 14 days.
Right.
Which meant they can't go for like a quick vacation with family, on a practical basis. But now there are a lot of other options. So I think you see a real drop off.
Gotcha. Okay. Our next question, and if anyone has a question, feel free to type it out. Our next question is, UBS says 100%, and I would never give 100% to anything in my life, but UBS says it's 100% US recession with no soft landing. What is your view?
So, we're living in la la land in this country, right? Inflation is transitory. The Inflation Reduction Act does nothing to reduce inflation, but does a whole lot, for the greening of the environment and the world. We have to have a recession. We have to have a recession. It's just a function of, and now the question is, how do you define a recession? And when do you define a recession? The historical definition of 2 consecutive quarters of decline in GDP, during COVID, we printed $7 trillion. We put $7 trillion of additional liquidity into the system, right? Just at the federal level. There are all sorts of state incentives and other things as well, which means you're spending more and more and more and more, right? That's why we have inflation, right? At a point in time, you start running out of those dollars to spend, right? So one of the things that we observed happen is if you didn't have to pay your rent and no one could evict you, you don't pay the rent, you have money and you buy some new Air Jordans, right? Or you buy a new Xbox, or you go on vacation, right? Same thing. You don't have to pay your student loans. Like all of a sudden you're cash rich and you're spending the money, right? Same thing with government and businesses. They're spending and spending and spending. Now we're finally at a point where credit card debt is rising, amounts of savings are declining. So people are spending, right? They're racking up the credit card bills. They're reducing the amount in their savings accounts. I don't think we're seeing another PPP or other stimulus ideas. I don't know what the Supreme Court has done yet, if they issued their ruling on elimination of student debt, but yes, there will be a recession. Do I think it's a hard or a soft landing? I think it varies depending on where you are, but I don't think it's soft. I think many of the things that were done during COVID were necessary at first and then just kept happening when they were no longer necessary, and we're going to pay the price. You just print money, tell people they can spend and spend and spend, and there are no consequences. Eventually there are consequences. So I agree. I don't know if it's 100%, but I would put it at high 90s. And I agree. I don't think we're having a soft landing. I think the people that have told us that from the government, we can have a soft landing, right? They're in la la land, and they're not held accountable for what they say. You're on mute. Ellie, you're on mute.
Sorry about that.
It's easier to hear you when the mute button is not on.
Sorry about that. Our next question actually ties into something that I wanted to speak with you about. And the question is, and I'll expound a little bit on it, is can you discuss the large discount to NAV in top tier REITs? So what are the catalysts that would close that gap? Is extended stay overdone? It's something that I want to touch on before we kind of got off on question tangent and other tangents. Is, if you look around and packet that we send out monthly, REITs are trading, large REITs, high quality REITs with high quality assets in top markets are trading at 10.5 times 2023 EBITDA, which historically seems to be pretty low, especially if you think about where assets are actually trading.
So let me cut you off for a second.
Sure.
10.5 times enterprise value to EBITDA multiple is not historically low for hotel REITs. It's historically low if you start history in 2009.
Well, that's when I started working.
Right. I mean, it might be historically low if you started at the end of 2006 because you had the REIT LBO boom and everyone traded up to like about 14 times. Right. But historically, when I started my career, right, the hotel REITs were trading at 8 times. Right. That's where they were, and they were lower levered. Right. Then they were lower levered, but that's where they were, and they weren't as much an accepted major asset class. Right. So there were lots of larger institutional equity investors that didn't invest in the REITs. So here, even the REIT universe is a little bit, weird, right? There are what, 14 public hotel REITs, something like that. The equity market cap of Host is 1/3 of the entire equity REIT market cap, right? Which is about $36 billion. So Host's equity market cap is about 12 billion. The entire equity, publicly traded US hotel REIT market cap is 36 billion. Okay, who else has a roughly 36 billion equity market cap? Hilton. So the entire hotel REIT industry has the equity market cap of Hilton, which is smaller than Marriott, which has about a $55 billion equity market cap. So it's a really small part of the overall investing landscape. What's interesting is the hotel REITs, we did a study of this a couple of years ago. I haven't updated it, but it won't be materially different. Right, the public REITs account for about 2.5%, 2 to 2.5% of the hotels in the United States. That's it. They account for about 5% of the overall room count because a lot of the stuff they own is institutional and bigger than a lot of the roadside, 50-unit motels. And tertiary market stuff. So they own bigger, broader stuff, but that's what the public hotel REITs own. So, we focus on them a lot because they give you a real sense of where the market thinks value is. And the market right now is valuing these broadly at a 20% discount to NAV, right? And it varies, that discount, depending on which REIT you look at, is anywhere from 10% to almost 50%, 45 to 50%. And all of this is based on, JF Capital estimates of value on an asset by asset basis compared against the publicly traded enterprise values. The one thing also that we don't do or we haven't done recently, and we find the sell side Wall Street equity research analysts don't do, is when we're looking at the enterprise value or the combined sort of value, aggregate value of a hotel REIT, we're taking the debt that they have and the preferred stock that they have at par value. Where in a whole bunch of cases, if you were replicating that debt, or someone was looking to buy that debt, it would not be worth the par value. It would be worth something less than that. So the enterprise values that we all look at, tend to somewhat in this kind of environment, tend to somewhat overstate the true value. Does that make sense? So I think the difference between the private market NAVs versus the public enterprise values is the public companies get influenced by flow of funds into the equity markets and into the REIT space. So if any of the large investors are, pulling money out of the market, right, they're selling. Right. They're selling, and there's downward pressure. Are any of the REITs going to tremendously outperform? It's tough to look through to performance right now. I think they're mostly trading as a group. There are a few outliers, right? So Park has been penalized in a major way for for some of their holdings, especially in San Francisco, now that they've announced, they don't plan to feed their two big San Francisco assets anymore. That should reduce if they do walk away from them, and we'll see where they end up with a special servicer, that should reduce their overall leverage by a turn, right? It should take away a lot of the headaches and a lot of the concerns that equity research analysts have, and you'll probably see a lift in their stock, right? I think there was a big sigh of relief when they announced about 2.5 weeks ago that they're not going to keep funding equity dollars into those two big San Francisco assets. So the equity markets are interesting. I don't think they're trading at crazy levels. I think if you look at where the REITs are trading on an implied cap rate basis, and I normally don't have any notes, but I wrote down like 4 or 5 notes just because I'm getting older. I don't remember things as well. The hotel REITs are trading at an 8.1% implied cap rate on 2023 NOI. If you looked at the same kind of cap rate where they were in 2019, it was 8.6%. Right, so not too different. Right, the problem they have is they've lost a few years of income. I think the hotel REITs, for the most part, and there are some outliers, are much lower levered than a lot of private borrowers. So the LTV, if you use enterprise value for the V, or the value of the public hotel REITs, is about 51%. And if you add in the preferred stock they have, it's about 58%. So there's a lot of room there. Now, there are a few that are much higher levered, but that's like the weighted average of the hotel REIT universe, whereas you might find something substantially higher, in the private world.
Gotcha. Do you think because there is that NAV gap that you mentioned between the private and the public markets, that in the next, call it 24 to 36 months, you will see some more taken private transactions?
I think you'll see some activity. I mean, normally what fuels the LBO activity is availability of debt financing. So, a lot of that is going to be a function of which investment banks are willing to stand up and provide enough capital behind a deal. And it's very difficult also, if you assume that today's interest rates are here to stay, to pay the current values. Like one of the other interesting things kind of about the hotel REITs is, they have a huge amount of fixed rate debt, and the term is not that long, right? So if you look at the entire REIT sector, hotel REIT sector, there's a roughly 3-year weighted average term on their debt, and it's at a 5.2% fixed rate, blended rate, and 85% of it is fixed. So what happens in 3 years? We talked before and said we think rates will be lower, but they won't come back to where they were. So all of a sudden, the REITs that are paying on a blended basis 5.2% might have to pay 6.2 or 7.2%, which will put further downward pressure on their stock prices.
Right,
because it'll increase their cost of capital, increase the discount rate. Assume everything else is equal, higher discount rate is gonna mean a lower value.
Right.
The other thing that's kind of interesting, right, is the REITs are trading right now on a blended basis, a weighted average blended basis at 75% of the 52-week high. Right, so they're down from their 52 weeks high and at a 58.9 or 60% of their 5-year high. Right, which is, to me, kind of interesting. They're way off of where they were, so the equity is compressed. If you compare that to the hotel C corps, they're at 88%. They're trading today at 88% of their 52-week high and 93% of their 5-year. So the C corps that don't have this big heavy debt burden, that don't have the big heavy real estate capex burden, and they're growing. They're growing and they're trading reasonably well, right? I mean, they're at 93% of their 5-year high.
Right. It sounds like it's been difficult to make money in the hotel REIT space in terms of being an equity investor. Is that, is that something that we could expect to change? Only because when you look at Hilton, you look at Choice, you look at Hyatt, you look at Marriott, those are all stocks, as you just said, that are, pretty close to their 52-week highs that really come back. I remember when Hilton during the depths of COVID was at $50 a share, or something crazy like that. Now it's at like 150 a share. So it is, what is it about the REITs that kind of give them a hard time in sort of bouncing back? And you have these, these large management franchise companies that just seem to just, grow investor returns, return capital.
So we all kind of do our underwriting and are trained when we start in the business, underwrite a hotel using a 4% or a 5% FF&E reserve. All of the analysis that we've done, and we've done the studies, we're happy to share them with anyone on here. We have in the past, we've looked over the last 20 or 22 years at all the public hotel REITs, and what we found is on average, they spend between 9 and 9.5% of their revenue on non-acquisition CapEx. So they're very capital intensive, whereas, they're very capital intensive, whereas Marriott and Hilton, Hyatt, IHG, others are not. Right? They need to keep investing in their systems and in technology, but they don't own the real estate. So they're not having to keep redeploying that. So we talked about the trading multiples for the REITs, right? If they're at 10.6 times today, right, on 2023, enterprise value to EBITDA, they were at 10 times in 2019 on average, or there's some outliers. And the C Corps today are trading at 14 times, and they were trading at 17.6 times. They're trading at 17.6 times in 2019. Very, very, very meaningfully different. So it doesn't look like they're, trading so crazy, but they're 4 turns higher than the REITs, when normally we would see a little bit less than that, right? But there is a premium for the ability to generate cash without having to keep making the capital outlays.
Gotcha. And this is an Ellie Grotko question. Given what you just said, the 14 times multiple versus a 10 times multiple, do you think, not that there is something, maybe there's no such thing as too much, but do you think the hotel management franchise companies are possibly charging too much? I know they're probably charging the market rate. They're charging whatever that they can get. But given where that hotels owners are, looks like that they're kind of struggling to pay the FF&E. They're struggling with the labor. They're struggling with all sorts of rising costs. Do you think that in the future, brand companies will give back more, will sort of discount more, or do you think things are just going to continue as is?
No, in fact, I think it's likely to go the opposite way, right? You've seen for some of the full service brands, right, over the last a bunch of years, in addition to their rooms royalty fee, they've added an F&B royalty fee.
Right.
I don't think so. I think if they charge too much, right, owners are going to say, I'm going to another brand, or I'm going independent. And some do. And in some markets, you can do just fine as an independent if you have the right operator, the right revenue management, system, tools, and team. But that's not for the faint of heart, right? Because if you think about how much Marriott or Hilton or Hyatt spend on an annualized basis in marketing, spend on their loyalty programs, spend, or have owners spend on their brands and their loyalty programs, it's huge. It's very difficult to catch up. So I'd be very surprised if you see royalties and other fees going down. I think you'll see investors and owners continue to push for more bang for the buck. But I don't think they're going down. I'd be very surprised. I'd be very surprised if that were the case.
And what would you say would be a prime example of a hotel that you think maybe should be an independent hotel? Like where would you say as like an owner, when you're thinking about flagging a hotel, is that line? You say, you know what, in this market, targeting this client, we're probably going to be a brand. In this market,
major urban markets, major resort markets without too many keys, right? If you have 800 rooms, you're really going to want a brand reservation system to be filling. If you have 150 rooms on the beach in Miami, like, you don't necessarily need a brand, but you have to have an operator who knows how to operate independently. Certain markets that are generally very high occupancy, on a year-round basis, New York is one of them, LA is one of them. So it doesn't mean that you shouldn't have a brand in those markets, but those are the markets where you'd start to do the analysis and say, does brand make sense versus not make sense? And you have to look not just at what the royalty fee costs are and the loyalty programs and all the fees. You have to look at where your contribution is going to come from, because if you supplement, and what we find is a lot of independents, have a higher OTA contribution where they're paying 15 to 20% commissions to Expedia or Booking.com. At the end of the day, it's not necessarily cheaper. So you need to look at kind of all of that and do it smart with an operator or an advisor, right? And we do a lot of that. We do a lot of the analysis, and we do more branded stuff than independent. But over the last 7 or 8 years, we've spent way more time in the soft brand space. So we're getting all the power of Marriott or Hilton, but have some individuality. And we've done a lot of Tapestry deals and Curio and Autograph. And, we're looking at a whole bunch of the Tribute. We're looking at a whole bunch of the other soft brands, because you kind of get the best of both worlds.
Gotcha. It looks like we probably have time for one more question.
That's it? Oh, you think it takes me 8 minutes to answer a question? I'll try to go fast.
Okay. What do you think are the things that may surprise people over the next year? Things that maybe people aren't talking about that in 12 to 24 months is going to be much more talked about, things that maybe are kind of below the radar?
I think a lot more people are going to be thinking and talking about sort of the real ADRs and sort of the impact. I think that's one. Two is, when looking at both the public hotel companies and others, a lot more scrutiny is going to be paid to ground leases, right? And the required disclosures in the public markets are not that robust. So you can figure out, yeah, there is a ground lease, but you don't necessarily know all the material terms that you would want to know to figure out what they're worth. I think you're going to see more and more discussion about technology, including artificial intelligence and including robots, because there are a lot of positions and a lot of things that we do in the industry that human beings don't necessarily have to do. And that's going to cause sort of a lot of arguments and a lot of fights in union heavy markets, where someone's told, like, well, a robot can handle this, like, we don't need you, or we can eliminate the entire front desk because we're going to have a screen and there will be a person or even a system, right, running on artificial intelligence that's able to check people in if they can't do it on their own. So I think there's going to be more and more need to embrace technology, and that goes hand in hand with just the labor challenges and labor costs. That's kind of what I think. But I don't think we're going to be talking about so many new things. I think we're going to be looking at some shifting of who owns what assets and at what basis. And I don't think the challenges we have right now are done in 12 months or 24 months, because, as I said, some people have loans that run through 2026. Well, they may need a restructuring in 2027 or in 2026, right? Not today. So, you're going to see people that are benefiting from having fixed rate debt today all of a sudden in 3 years or 5 years, in fact, like the entire REIT universe, right now they're lower levered, so they can afford to take on a little bit more. They have more options. They could put mortgages on individual assets instead of at the corporate REIT level. But I think we're going to have a bunch of years to sort of sort out what's happening and what happened as a result of COVID and what happened as a result of the government pushing rates up 500 basis points in a very short period of time.
Gotcha. Okay. And okay, another question. In terms of different types of assets, right? So I can remember when I first started to work with you in 2006. You wanted a big box in New York City. That was an amazing asset. And then through COVID, you wanted the extended stay assets, and you wanted kind of smaller assets. In 3-4 years from now, which asset class do you think is going to be that class that people are going to say that's the one that you want to be in?
I'll be some of both. Again, and it really depends on your source of capital and your timing, right? A lot of people have plowed into the extended stay ownership business, and even limited service and select service business because the cash flow is good, right? So they got hit the least, from a COVID perspective, because truckers are still driving on the interstate, delivering whatever they deliver. Contract crews are out there doing whatever they do. Some people were in between homes or, using extended stay, lower tier extended stay properties as housing. So in a lot of cases, it was a necessity, not a luxury. Whereas going to a Four Seasons or a Peninsula hotel or a Ritz-Carlton hotel somewhere is not really a necessity. I mean, it might be depending on who you ask, but for 99% of people in this country, going and staying in a luxury hotel is not a necessity. So it's really gonna vary based on where your capital comes from, what your investment horizon is, right, and what you're comfortable with. Right. If you're an excellent limited service operator and you decide, you want to buy a luxury hotel in a major urban market, that may not work out quite the same way, because you're going to walk in and decide you can slash costs and slash labor all over the place, and you then won't be able to charge the rate.
Mm-hmm. Right.
So I think we have only 2 minutes left. So let me say a couple of things just to wrap up. So I think it was at 6 different conferences in the last 6 weeks, all over the country, in LA, in Las Vegas, in DC, in Dallas, in New York. The last one I was at was, and they were all kind of hotel related, hotel specific, except for 2. So I'll talk about the last one, which was the CREFC conference, which is real estate lenders, servicers, special servicers, last week in New York. So yes, I was at the Marriott Marquis in New York 2 weeks in a row on Monday and Tuesday. And they're talking, the special servicer panels got way more attendance than ever before. Full rooms, every seat taken. They were talking about office and talking about retail. And when people ask questions, well, what about hotel? They're like, not nearly our biggest problem. So again, this is, more geared to CMBS, but some balance sheet, some debt fund. They were like, hospitality hasn't been our big problem, because even though performance might be somewhat distressed, we think there's a recovery there. Office, we're not sure if we're ever coming back to the level of office usage that we've had before. So, that's kind of a way that's saying hospitality doesn't suck as much as some of the other asset classes. Plus, we have more fun, and that's what I got. So Ali, thank you for kind of poking me and trying to get me to answer the questions. Thanks to the attendees. This will be recorded and available for distribution. But thanks for joining us for JF Capital Unplugged number 7.
Thank you, guys. Have a great day.